A lot of bulls about equities right now. You have some doubts about it. Why do you have some doubts, Peter?
Well, when you look at the strength of the markets, and particularly the interest rate market, and as well as what the Fed GDP now came out today with growth over 5%, it's hard to think that the Fed is going to pause right here. And in fact, our thinking is that the Fed may raise, it may hold on. I don't think it's going to raise again the rest of this year, but there's very low probability that the Fed cuts between now and election day. And the yield curve itself, which, as we know, has been inverted, is likely to move back towards its normal state. And if you think about that, if you have 4% nominal growth, and the Fed now was over 5, and then you have 2% real interest rates, you could see that the 10-year, which is at 4.17, as you just showed, could easily go towards where the Fed funds rate is, which is 5.5 to 6% by the middle of next year.
And those higher rates are just about never good for equities, as you know. But there are other issues out there as well. We have a looming possible strike with the UAW, maybe a government shutdown. What are the risks in the fourth quarter for the economy?
Well, if we have a government shutdown, and you know that Congress comes back in next week, and think about all the spending that needs to take place. You had the hurricane in Florida, you had the tragedy in Hawaii. If all of that is shut down, that could really significantly slow the economy, but it's temporary. So the Fed is not likely to do anything or go off course. That could then be very challenging for equity markets, because with government spending going down, aggregate demand will be reduced in proportion, and that will hurt stocks.
So, Peter, what does that tell you as an investor? Where do you run to hide if, in fact, we have some of these risks out there?
Well, one of the great places to hide, of course, is in short-term treasuries, because they're paying a high yield. They're safe. It keeps you out of the whole debate of, are they going to raise? Is the yield curve going to move? And I always say the hardest thing in life is to rebalance a portfolio. And if you've had a great run this year, particularly in some of the tech names, going back and reweighting your portfolio to where your weights should be as an investor is something to do. It's always a challenge to do that, because everybody thinks that it's going to continue to go higher. But with volatility goes up, those stocks that have gone up the most are also likely to be the most volatile.
So with volatility, if it in fact does go up, Peter, does that mean you want to be as short-term as you can across the board, whether it's cash, whether it's short-term bonds, whether it's something else?
I think you want to go shorter term, because that's the nature of volatility and uncertainty. And from that type of perspective, when you look at the breakout of energy, when you look at the strength of the dollar, these things are all telling you that the U.S. economy is far stronger relative to the rest of the world, and that's going to continue to put pressure on rates, particularly on the longer end, and that will likely add to stress in the equity market.
Peter, one last one here. China. China's in the news just about every single day. The economy is not going as well as President Xi would like it. They keep trying to do something to shore it up. How does that affect the United States economy and, for that matter, U.S. investors?
Well, China is kind of exporting deflation. You can see that in the relative value of the yuan versus the dollar. And in markets, all marginal demand matters. If China is not supplying that, in their case being the largest or the second largest economy, depending on how you measure it, that will then put stress on prices, and that in itself is a little deflationary, which is ironic, right? Higher energy prices where demand is inelastic causes some substitution effect. A stronger dollar is also deflationary, and that too could be a stress point for profit margins for companies as we go into fourth quarter earnings in October.